FX Nation, what's up, guys? Welcome to Forex U. And in this set of series of videos, we're going to go over how you're going to be trading the Forex market. Now, you've learned the basics already of, the calculating pips, what a pip is, what the Forex market is, the candlesticks, and all that stuff. You've gone through the very, very basic of what the Forex market is and the different aspects of it. What I'm going to do now is we're going to show you in the next series of videos how to trade the Forex market so you can become profitable. And there are going to be hundreds, literally hundreds of different strategies out there that you can actually use to trade. I'm going to show you one that I use myself, every one of my members use, and this is a strategy that I have back tested, so I know that it works. Okay, and the strategy itself is going to be the market maker method. Okay, so you might be asking yourself, what is a market maker? What is a market maker method? So a market maker. So market makers are basically uh, banks, dealers, brokers, the big people within the forex market that are that hold hundreds, trillions of dollars that are traded within the forex market. And market makers basically control the market itself. They are able to manipulate the market in their favor. And this is one of the reasons why the Forex market itself has such a high fail rate when it comes to retail traders. Retail traders meaning me, you, and everybody else that's not a market maker. So you've learned the basics. Now we're going to get into the foundation of the market maker method. Okay, so the foundation itself starts off with the market maker cycle. So one of the things that you need to understand, and the faster you understand this, the easier it's going to be for you. Okay, so the forex market itself is manipulated, it's rigged, okay, by these market makers. Okay, these banks, these dealers, these brokers, they're trying as hard as possible to get you to trade and to trade the wrong way against them. Okay, that way they can literally just take your money. Okay, so the faster that you understand that the forex market is manipulated, the easier it's going to be for you to trade. Now, you have to think about it like this: there's market makers, and then there's us retail traders, meaning you, me, everybody else out there that's on on Facebook or out there that's basically trading for themselves, that's not a part of a bank, institution, a broker, or a dealer. Okay, those are all retail traders. Okay, now the market maker cycle itself can be found on all time frames with the patterns that repeat themselves over and over and over again. Okay, now the market maker cycle itself, which I'm going to show you what it looks like once we get into the charts, but the pattern itself goes on anywhere from between 2 to 5 days. Okay, and then it repeats itself. So the main goal here is to identify the pattern and trade with the market makers. Okay, you want to be trading with the banks. You never want to be trading against the banks because you're going to end up losing and blowing your account. Okay, so very important is to identify the pattern, the cycle that they're in, and trade with them. Okay, never trade against market makers because you're going to end up losing. And it's very important that you learn how to spot the different variations of the patterns that I'm going to show you of the market maker cycle. Because if you can learn to spot the different variations, you'll know exactly what the market maker is doing. And the most important thing that you can possibly do is stop thinking like a retail trader and start thinking like a market maker. Think like a market maker. Do not think like a retail trader. If you think like a retail trader, you're going to end up doing retail trader things that is going to make you lose trades and possibly blow your account. Okay, so very important to spot the different patterns, the different variations of the market maker cycle and the pattern that I'm going to show you, so you can trade in line with the market makers and not against them. So, in order to beat the market maker, you have to understand what their objectives are. Okay, you have to understand what their objectives are in the market when it comes to these market makers. Okay, so there's a couple different objectives that I'm going to go over here with you. So the first one is one of their objectives is to induce traders to take positions. Why is that? Well, because the market makers can't make money unless you're in an actual position. So if you're not taking any positions in the market, they're not making money. So the first thing that they try to do is induce you into taking a position into the market. Okay. Another thing that they do is they love to create panic and fear to get us traders to think irrationally. Okay. They love to create panic and fear to get you, the trader, to start thinking irrationally. All right. So, very important that you keep that in mind. The next thing is that they can hit the stop losses and clear the order boards. Okay. So, at any point, if they wanted to, they can go ahead and hit stop losses and do what we call a stop hunt. um, and basically it clears all of the pending orders, and basically it gets traders into trades. If you have like pending positions like a stop, like a buy stop, sell stop, or buy or sell limit orders, um, and it basically allows them to either get people into trades or also get people out of trades by hitting their stop losses. Now, another thing that they love doing is they love to force traders into margin call so they can pocket your money. Okay, so what is margin call? You ever seen another trader, or even maybe yourself in a demo account or something, and been in a position where you knew that you were so sure about whether an actual pair, a forex pair, was going to go up for the next day or so, and so you bought, and you were so sure of it that you took multiple positions, or you over leveraged your account and actually put in multiple orders of buying or selling with the hope that you would be right and double or quadruple your profits. Instead of just taking one trade, you took, let's say, three or four trades instead of just one. Now, what this does is, if the market maker starts to do what they like to do, which is hit the stop losses or try to clear the boards or orders that are on there, they love to do that in order to get you into margin call and get you in trouble. Basically, draw down your account to where you're basically almost blowing your account. And believe me, they know exactly where your stop losses are. They know exactly how much money is needed to get you to blow your account and get margin call on you. Okay. So that's one thing that you have to understand, is that they do have the ability to see everything about your account, especially your brokers. So if you look at the picture on the right here, this is UBS, one of the biggest market makers in the world. That room right there is full of traders that are professional traders that trade for UBS, and literally all they're doing is wanting you to fail. Okay, this is what you have to go up against. This room. There are hundreds of rooms like this throughout, the big banks, dealers, brokers. So this is what you have to deal with. Okay, so one thing you have to take into account is the fact that this is why you don't want to trade against them. You always want to trade with them, because there's no way you as a single trader can compete against rooms like this filled with traders that know what they're doing, and most importantly can manipulate the market. So in order to beat the market makers, you have to understand fully what can the market makers do. Okay, so market makers can requote you at will. So anytime that you place an order to buy, let's say Euro USD, you'll find sometimes that you'll be requoted. And that's basically saying you put in an order to buy Euro USD, let's say at 1.3500, and you place the buy order, you'll get a kickback on your trading platform requoting you for 1.3520. This will happen at any point. This can happen to you. So know that market makers can requote you for a different price. Okay. And when they do that, obviously they're wanting to do that to pocket more money from you. Market makers can control the spreads. Okay. Think about it. Your broker are the ones that control the amount, the spreads that are that you're able to see and trade with, right? When you're looking at your pairs, do you ever notice how when you're trading news, like let's say a minute or 2 minutes before the news release comes out, that you'll notice the spread will go from, like, let's say a 3 or 5 on Euro USD. It'll go from 3 to 5, and then it'll automatically jump to like 20, 30, 40. Okay, this is them controlling the spreads because they know high impact news is about to be released, and they just love taking money on high impact news. They know a lot of traders think that they can just trade news, right, and make triple and try to triple their account because they over leverage their account. Instead of trading normally or not trading at all during news, they go ahead and actually make the stupid mistake of putting 2 or 3 trades on, let's say for a Euro USD pair when USD news is coming out, right? So they're going to be able to make the spreads a lot bigger from 3 to 5, like it normally is, to 20, 25, 30, whatever it is that they want it to be, depending on how big the news is. The biggest spreads typically you can see on NFP, which is the first Friday of every month. Now, market makers can trigger your stops at any range. Okay, market makers can trigger stops at any range. Okay, it doesn't matter where they are, they can trigger the stops if they really want to. Okay, so just keep that in mind. These aren't things that they automatically do all the time or anything like that. These are things that they can do and will do sometimes. So this is just something that you need to understand, that of things that the market makers can do. Now, the market makers can also hold a price level or extend it so that it becomes visible on your chart. Okay, so they can hold a price level or extend it if they need to so that it becomes visible on your chart. So have you ever noticed how sometimes you'll have price getting stuck at a level of resistance, for example. And if you know the different type of strategies that are out there, a lot of times you'll have traders that have pending orders right above that high to either buy or to sell, right? Most of the time it's the breakout traders that have, like, let's say, a buy stop order, a pending buy stop order. As soon as the breakout happens to the and breaks resistance, they'll be in the trade. Now, keep in mind that these market makers will have a tendency to hold price levels right at that high, and sometimes they go ahead and they actually widen the spread out so they can pick up those orders and get the buyers into the buy trade, and then take it right underneath them and basically drag them back down. Okay. And market makers know who's in margin trouble. So they know all of what clients of theirs are in margin trouble. Okay. They have a MetaTrader um, manager window that they are able to see every single one of their clients, and they know who's in margin trouble. They know whose account is about to be blown. So keep that in mind. Now, let's talk about trap moves. So trap moves are basically moves that happen at the beginning, moves that happen essentially at different points throughout the week, throughout the day, throughout the session. And these moves are made to trap traders into a sell or trap traders into a buy. Okay, so let's say you see some traders will see, breakout happening for a sell, and they place a sell, and that basically is just a trap move by the market makers to get you into that order. Because again, if you're not in an order, they can't make money off of you, right? So they do these trap moves in order to induce you to take a position, and as soon as you take a position, it goes against you. You ever been in a trade on a demo account or even on your live account, and as soon as you enter the trade, you're negative? Like literally, like it goes against you. Like at no point does it actually go positive. Like it literally feels like the market. It feels like somebody knew you're placing that order, and immediately it went against you. Okay, these are called trap moves. All right, they typically happened at the beginning of the week, so Sunday, Monday, typically to create either the high or the low of the week. They can happen at the beginning of the day. They can happen at the beginning of the session, at the end of the session, at the end of the day, and at the end of the week. Okay, so beginning of the week, ending of the week, beginning of the day, end of the day, beginning of the session, end of the session. You get it? So at the beginning and at the end, these are where the trap moves are made. Okay, these are where the false moves are made in order to induce you to take a position that is going the wrong way. So, what does a typical day look like? So, typically we have three major sessions, right? We have Asian, London, New York. Now, accumulation typically happens during Asian session, and this is where the initial high and low are set for the day. So you'll notice that during Asian session, um, you'll have a lot of accumulation, basically a small range of maybe 25 pips or so. And price literally will go up and down, up and down, up and down within that range. It's basically setting the initial high and the low for the day. After that, we have what we call a stop hunt or a false move out of the Asian range against the real intended move. Okay, so think about it like this. During Asian session, we have accumulation, which is basically the initial high and low are set. So we're moving essentially up and down within, let's say, 25 pips or so, up and down, up and down, up and down. As soon as we get towards the beginning of London session is where they like to make, let's say, what we call a stop hunt move or a false move. And this is basically, it'll make a move outside of the Asian range against, and basically induce you to either go short or long right at the London Open. And what that does is induces you to take a position, and then essentially it's just a false move that they love to do, and then boom, they take it away from you and it goes against you. Trend move. So the real move that usually goes for 6 to 8 hours. It's slow and steady. So the trend move is the real move that the market maker is wanting to do. And typically these moves, since they happen at the beginning of the session, um, they like to go on nice, slow and steady for 6 to 8 hours. Sometimes it can go longer. It can go like both sessions. Most of the time, you can get, just one session. But the trend move is the real move. Okay. And usually it's very slow, very steady, going up, 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 or going down, down, down for, 6 to 8 hours. Now, at the end of the day, you have essentially the reversal off the high or the low, and then back into consolidation. So let's say that on Euro USD, we were at Asian session accumulating between that 25 pip range, up, down, up, down, up, down. Here comes the London session, and so let's say their real move is to go down. Okay, it's to sell, right? So what they'll do is they'll accumulate for Asian, and then at the beginning of London, Asian and London dealers will talk, and they'll think about what they need to do for the rest of the day, or at least for that session, and then you'll see a false move out of the Asian range, okay, to induce you to take a trade. So in this case, let's say that the false move was a buy, right? It was going up to get you to buy Euro USD, right? So they made the false move out of the Asian range to buy, got traders trapped because everybody was like, hey, look, it's going up, we're going to buy, right? So they made their false move, and then they went to their trend move, which is their real move that they intended to do, which is sell. So it starts slowly and steady going down for the rest of the session, right? Rest of London session. Sometimes it can go London and New York. Most of the time it's just one session, right? So it gets towards the end of the, let's say, London session, and then you'll start to see while London and New York brokers start talking to each other about what they need to do, you'll notice that it'll create either the high or the low of the day. In this case, it would create the low of the day, since during London they went all the way down. So it'll create the low of the day, and then you can trade off that low of the day, so it'll come back up a little bit, and then it'll go back into consolidation. Okay, and the cycle essentially starts over again. Okay. So what are going to be the trading hours for this? So typically is 5 p.m. These are all Eastern times, by the way. So around 5 p.m. all the way through Asia. So 5 p.m. through about 2:30 is basically the Asian session. Okay, that's where the initial accumulation phase happens. That's when the initial high and low is reset and done. Okay, and I'm going to show you all this on the charts once we get into the charts, but I just want you to grasp the concept. Okay, from 5 to 8 we have end of day, which we call gap time. Okay, anytime I can tell you that the best times that you're going to want to trade are London and US. Everything else really doesn't matter, to be honest with you. So London and US, are going to be your trading sessions. Okay. So 5 to 8 is typically end of day, and it's basically what they like to call gap time. Asian session is from officially 8:30 p.m. to 3 a.m., which is the accumulation period. London session is 3:30 a.m. to 9 a.m. This is where you'll see the stop hunt and the trend move. New York session is at 9:30 to 5. And then this is where you'll get your reversal end of day consolidation, right? So let's talk about this. So the gap time is basically the time in between the sessions, right? So let's say the Asian session ends at 3, but the London session doesn't begin until 3:30. So from 3 to 3:30, that is a gap time. Okay, you have the smaller sessions before the Asian session, but really those sessions that 5 to 8, those sessions really don't even matter, because they don't move. Price doesn't move that much during that specific time. That's why we call it gap time. Okay, there's just nothing happening between that time. Just like between 3 and 3:30, not a lot is happening, because right now the Asian session and the London session, they're both talking to each other to see what they need to accomplish during the London session in order to get price where they want it to be. Okay, same thing between 9 a.m. to 9:30 a.m. Again, gap time. That's when London talks to the New York session guy, and they strategize about what needs to happen during the New York session. 5 p.m. you'll have the end of day, and you'll have a reversal happen, and it just goes into consolidation essentially. Okay. So, what are the phases of the market maker cycle? So, the phases are basically induce, trap, and shift. Okay. There's 3 levels of rise or drop. There's an M or W formation at the high or low of the day that forms, and this is what we're looking to trade. And then the reversal back into the range and into consolidation. Okay, so again, it's just basically literally all starts with Asian. After we induce, they trap, and they shift. Okay, they induce, they trap traders, and they shift are the phases of the market maker cycle. There's three levels to each cycle, 3 levels of rise, 3 levels of drop, depending on whether they go up or down. And at the end of each 3 levels, there's going to be an M or W formation at the end that creates the high or the low for the day. Now, the weekly market maker cycle. This is what the weekly market maker cycle looks like. Okay. Here's 2 examples. So what you're looking at is the red box. That is your Asian session, right? That's your range. That's your 25 pip range in the Asian session. Nothing really is happening. And then you'll see that right after the Asian session comes the London session. And what happens? You have, on the example to the left, you have your false move to the high, right? So you'll see that on the left side here, the false move is to induce traders to buy, right? They induce traders to buy. As soon as they induce traders to buy, you'll go ahead and see a pullback, and then what they'll do is they'll go ahead and go back up to that same level, to that high of the day, to basically trap other traders. Okay, so you'll have the Asian range, you'll have the false move to the high, they'll come back, they'll hit the high again to get more traders to buy, and then it drops, and that's what creates your M formation. Okay, and then you'll have level 1, which is the first A, level 2, which is your uh, your second day, and then it bottoms out, and then it creates basically a W. And that's your end of day. Same thing if you look on the right, it's just the opposite. Basically, they make their false move to the bottom this time, create the W, and then you have a V for level 1, a second V for level 2, and then level 3 creates the M, and then it reverses again. Okay, and like I said, we're going to go over all of this in very good detail when we get a chance to look at the charts. Just understand the concept first, okay? So for a market maker cycle that's going down, okay, that's selling, the pattern is MAAW. For the market maker cycle for buying is WVVM, okay? So what does retail traders see, right? So what does retail traders, everybody else that's retail traders, what do they see when they look at the markets, okay? So retail traders, the retail trend is seen by the herd, by everybody, simply as a rising channel that will keep rising, right? Now, with the market maker cycle, we know better than that. We know that it's not just going to keep rising forever, right? We know that there's 3 levels of rise before we see a drop, right? And so we want to be on the right side of that. Now, the market maker trend starts once the M or W on the top or bottom locks and the count starts to run lower. Let me show you what that looks like. So here we have the channel, right? The uptrend channel that everybody, all the herd retail traders are looking at, and they're looking to buy, right? They'll look to buy at either level 1, level 2. Most of the traders, here's the thing, most of the traders will actually look to buy on level 3. And why is that? Because they're looking for confirmation and they are not sure if this is really an uptrend. Okay, so the first time they see the first level 1, they're like, okay, this could be an uptrend. Second level, they see, they're like, this could be an uptrend, but I want to make sure. So they wait for the level to go up one more time, and then now that they're convinced that they're at level 3, okay, and it's created half the M already, that's when they actually take the trade to buy, right? And initially, some of them may actually be in profit. But what happens is market makers hit the high and immediately get out of there once they have enough orders filled to go ahead and start selling. Okay. And we want to be on the right side of that trade. So we're going to be on the selling side, not the buying side. So looking for trade setups. So when we look for trade setups, we're trying to identify where you are in the cycle. Okay, that's the first thing you want to try to identify is where you are in the cycle. That way you can predict where the next move is going to be. So once you identify where you are in the cycle, then you could drop down to a lower time frame to find a trade setup or entry. So to identify the cycle itself, you're going to be looking at the 1 hour charts. Okay, and you're going to be looking at the 1 hour charts and you're going to try to identify where you are in the cycle, whether you're at the W at the bottom, whether you're at the M at the top, whether you're at level 1, 2, or 3. Okay, it's very important to try to identify where you are in the cycle, because think about it, if you know that you're on a level 1 of a W, right? So let's just say we had our our W form, and then we see the consolidation from the previous day to level 1. So we know we're at level 1. What do you think the next move is going to be, right? We need to go up to level 2, right? So this gives you your bias for what you're looking for the market makers to do, which is do a false move or stop hunt low and then rise to make level 2. Okay, so The recommended time frames that we're going to use to trade is basically are the 1 hours and the 15-minute charts. So 1 hour is basically to identify what part of the cycle you're in, and the 15-minute is going to be for your entry. And here it is again. So the 1 hour charts are going to be for your directional bias, and 15 are going to be for your entry and second leg of the M or W formation. And like I said, we'll get into this in very good detail once we get to the charts. All right, so we're going to go ahead and start talking about pattern variations, because if I just told you, yeah, just go ahead and trade an M or W pattern, right? You would start trading every M and W pattern. And in reality, that's not what we're here to do. There's going to be several different pattern variations that the market maker does that we've identified that are going to allow you to be the most profitable. Okay, so we only want you to trade these specific patterns because we know what the results are going to be between 85 to 90% accurate. Okay, we are not in the gambling game, we are not in any type of 50-50 proposition. Okay, we are in the 80 to 90% rate of actually trading. So what that means is out of every 10 trades that you do, you should be winning at least 8 of them. Think about that. You should be winning at least 8 out of 10 trades as long as you follow the rules that I'll give you and the patterns that I'm going to give you. If you follow that to the T and do not let your emotions get control of you, you will be successful. If you can consistently just trade these patterns, you will be successful. Okay, so we're going to go ahead and flip over to the charts now, and that way we can take a look at the different patterns, and I'll break everything down for you when it comes to the market maker cycle. All right, guys, so let's flip over to the charts, and we'll see you in a second. All right, guys, so let's go ahead and talk about the patterns and the cycle, so you can visually see what I'm talking about. So first, let me just go ahead and show you visually the cycle. Okay, so we're looking at USD JAPI on a 1 hour chart. Okay, and here's what I want you to notice. Here's the pattern. Okay, I'm just going to draw it out for you first so you can see it. Okay, so here we go. We're forming the M, and then here we go. We're forming level 1, going down, level 2, coming back down, and then here we start to create the bottom. We go back up, level 1, here we go, create level 2, and then up to level 3, basically ending at the M here, and it just goes down from there. All right, so as you can see, this is the market maker cycle. Okay, this is the market maker cycle. We have market makers going up, creating the high, coming back down, retesting the high, right? Inducing traders. Notice this right here. Notice that spike. You notice how that spike basically, here's the previous high right here, right? Notice that spike right there. Do you see that? Let me remove all this stuff. Look at that spike right there. That happens right here. Look at that spike right there. See that? Came back, and you notice how I didn't close above it, right? It spiked above it. Here's why. Because all along this level here, you have your breakout traders, and they have essentially all of their pending orders for, in this case, being a buy stop order, right? And here they are all right here. So what they do is they come back up, right? And remember, at one point, this bar here was solid blue, right? Remember that. This bar here was solid blue. So they entice traders, hit the orders, and at this time as well, they're also spreading, making the spread bigger, right? So you would normally get like a line here for the bid and another line here for the ask, right? So it'll widen the spread, and basically it'll go ahead and hit all the orders that are here just pending for the traders, right? Once they do that, they immediately draw away from that zone, right? And then here we go, we accumulate again for level 1. We make another move, boom, level 2, and then we get to the bottom here, and then this is going to be level 3, and at level 3 we're going to want to look for a W, right? And so here's your W here, coming back up, down, and then it takes off. Now, one thing that you want to notice here, sometimes when they create this W, notice how the bottom of the first leg is right here. The bottom of the second leg came here, right? Now, why would market makers do this? Why would they not come all the way back down to this level again before going back up? Why would they come just to this level here and not down here, right? Here's why, okay? Let's say that traders are selling right here, right? And they're like, this is a pullback, and then we're expecting another move down, right? So here's what happens is whenever they make this move, if they come back down here, right? You have to think about the fact that, okay, traders get here, they get on here, they're in profit, and then we have a pullback, right? So now some traders that got in down here are negative, right? Other traders may be just a little bit in profit. So what happens is they'll go ahead and pull back. Sometimes though, they want to go ahead and actually trap the traders, right? So they'll do this, and they won't come back down to here because they don't want traders to take profit or to break even. Okay, so they don't want traders to break even or take profit down here, so they'll go ahead and do that instead. Okay, so just keep aware of that. But here is the entire market maker cycle right here, as you can see it. Okay, I'll draw it out for you again here. Boom, level 1, 2, 3, W, away, 1, 2, 3, up here, make an M, and drop. All right, there it is, right there on the 1 hour chart. Okay, if you see this, if you can identify this, okay, just think about it. If you can identify that you're here off of this level 3 here, think about, you know what the next move is. It's going to go down again. If you're down here and this is not here, right, and this is all empty, imagine, you already know what's going to happen. It's got to go one more level down, right? So there's your sell trade right there. And here's where the retail traders are, right? So retail traders are like, here, I'm going to do this, and we're going to go down again, one more, right? So all the retail traders sell here, probably, to get in on the trade, and then here's where the market makers trap them. They don't even go down, and they push right back away. All right? So that is the market maker cycle. Okay? Now, what we're going to do next is I want to go ahead and show you the the accumulation phase and everything like that. We're going to break that down next. So what we're going to do is we're going to go into Euro USD, and this just recently happened. So I'm going to pick this up right here and I'll break this down for you. So here is Euro USD, and what we're going to do is we're going to draw a box around the Asian session, okay, and that's typically that's from 8 to 2, so it's from right here to 2 in the morning, which is right here. All right, so that is your Asian session. Okay, now as long as you have your trading software or chart software set to Eastern, you'll notice that it's basically from 2000 all the way to 2 in the morning right here. Okay, this, as I talked about before, this is gap time right here. This line here is 5 o'clock. So this is basically from 5 to 8 gap time, dead time, right? This is basically smaller little sessions like the Sydney session, the Wellington session. These are all very small sessions, and the price really doesn't move all that much in these sessions. Okay, that's why we call it gap time. All right, but let's go ahead and measure this out here and see. So you can see, wow, this is actually perfect. Look at that. 325 pips right there, Asian session. You see that? Almost 25 pips. It actually is 25 pips. Yep, 25 pips, Asian session. Okay, so check out what happens, right? Right after Asian session, guess what happens? We have our false move, right, which is right here with these two candles. So this candle here, that candle there. Most of the time, it's 3 candles. Sometimes it's 2 candles. It just depends, right? If it was 3 candles all the time, it'd be too easy to predict, right? So market makers like to change it up. So sometimes they'll use 2 candles. Most of the time 3. I've seen them use even 1 candle. Now, if you do see in 1 candle, if you do see it in 1 candle, then it's going to be a huge candle, obviously. But for the majority of the time, we're looking at 1, 2, or 3 candles. Okay. So we have that, right? We have our false move down, and it basically creates the low of the day. Now notice how the first leg here, spikes down, right? See that? Look at this. Can't tell me that's not a false move. Look at that nice 2 big candles, and then look at the empty space. So at one time, this was a full candle, right? And it spiked right back up. You see that? Now, in this particular scenario, right, here's the low of the day. It did not create a W, but what it did do, it gave us a confirmation because it gave us what we call a railroad track. And we're going to talk about what we look for here in the next video, but just be aware that this is what we call a railroad track here, and all it is just basically 2 massive candles next to each other like this. They look like a railroad track, right? They look like railroad tracks. So this is something that we use to confirm when we don't get W's, right, we use railroad tracks. It's just one of them. And then look what happens for the next session. We rise, right? And we rise, I want to say, let's see how much we rise here. So a good 41 pips, 40 pips we rise, right? Now, if you, let's say, take a trade from here, it's like 50 pips. But in reality, you know, it's more like 40 pips because you need this to develop first, to make sure and have that confirmation. But we rise, okay? We rise out, and then if you notice, this right here is around 5:30. We have the pullback here, and then guess what? Here is towards the beginning of the U.S. session. U.S. session starts at what time? 9:30, right? So between, here we go, between 9, which is this candle here, and 9:30, which is this candle here. Okay, so in 2 candles, this is the 9:15 candle and the 9 o'clock candle. Look what happens. Look what happens between those 2 candles, right? We have our false move to the top. We're faking everybody out, and we're false moving to the top. We're trapping them on buys, and then we're just moving back down, and we're essentially consolidating for the end of the day. All right, so look, consolidation, consolidation. Do you see that? Here's the next day right here. So all through the U.S. session, was consolidation off the high of the day, right? So we created the low of the day down here, and then here's our high of the day. During London, you would have caught this trade here, the whole thing if you wanted to. Okay, so that is what we're trying to do. This is what we're trying to do. Okay, we're trying to catch those moves. And in reality, the overall goal of you trading this is, I just want you to catch 30 pips. Okay, 30 pips. So basically, you would have entered in here. This would have been your trade. And by, let's say, 5:30 in the morning, you would have been done. Okay, you would have been done by 5:30 in the morning. So you figure from 3:15 to 5:30. Okay, so in like 2 hours, you're done trading. You would have gotten 40 pips. If you think about it, if you make a standard lot, right, 40 pips, that's $400 in 2 hours. You tell me, where else can you make that kind of money? Let me know. I'll wait. All right, guys. So this is what I'm talking about here. This is the perfect setup of what we're talking about. Okay. So this is the accumulation phase here. Remember, gap time, accumulation, false move, the real trend. Okay, and that's going to be our trade. And remember, it moves slowly, slow and steady. And remember, 6 to 8 hours. So if this went all the way over to 9 o'clock. So from 3:15 all the way to 9. So 6 to 8 hours. Here it is right here. You see what I mean? So, and that entire move there was, 75 pips, 73 pips, around there, so, and think about it, you're just wanting to catch 30 to 50 pips max, 50 pips on a standard lot, that's $500. So, that's not a bad deal at all. Okay. So that, my friend, is the standard one of the trades that we're looking for right here. Okay, right after Asian session. But I want you to see visually what it looks like. Accumulation during Asian, our false move down, and then we make our rise, right? Sometimes you'll see the false move go up and then we drop. Okay? So that right there is a perfect example of what I'm talking about. All right? So what I'm going to do now is I'm going to go ahead and show you the different types of variations on the pattern. And I'm just going to draw this out for you. Okay? So we have 3 specific types of patterns that we're going to look for. All right? 3 specific type of patterns. If you trade these patterns, you will make money. If you try to trade any other different type of pattern, you're not going to get the results that you should be getting. All right? So here we go. So let's just draw out, let's say the Asian session. Let's draw this out in real time here. So 2 and right there, right? So that right there is going to be your Asian session, right? So we have, let's draw this out here. So we have our accumulation phase here, and price is just basically going up, down, up, down, up, down, right? So I'm going to show you type 1, okay? This is pattern setup type 1, all right? So type 1 pattern. Is what this is. All right. So here's how it goes. This is the most powerful pattern out of the 3. And if you get it, you take this all day, every day long. All right. So here it is. So we have our accumulation phase, and then we have our false move down in this example. And then we have creates our W, and then we have this. Okay, that is a type 1 pattern. All right, so the important things about type 1 is that the false move, notice how the false move, right, created a new low below the Asian range. Okay? Created a new low so false move created a new low outside of the Asian range. Okay? That is very important because that is what creates a type 1 pattern. Okay? That is what creates a type 1 pattern. All right? So that, my friends, is type 1 pattern, and we'll get into the entries and everything like that in another video. We have a separate video for specifically for entries. Right now, I just want you to analyze and know the actual 3 different types of patterns. Okay, so this is type 1 pattern. All right, we're gonna go over to type 2 pattern now. So the next one is type 2 pattern. So, and here's what it looks like. And by the way, if this was not a sell, or if this was this was turned around, this is what it would look like, by the way. So let's just say that instead of going down for the false move, it's going up for the false move, right? So it'll look something like this. False move up, and then it would just create essentially the M, and then come back, do this, come back down. Okay, that would be the false move if it's going up. All right, so false move could be going up, could be going down, depending on where you are in the cycle. Depending on where you are in the cycle determines where the pattern's going to go, where the false move is going to go. Okay, so let's say, for example, is that we are on, this is level 2, let's say, and so we already have, you know, this up here, and we had level 1 here, right? And then we had, boom, level 2, right? So we're at level 2, and of course we're going to have a stop hunt high, and then we're going to drop. Okay, so that was type 1 pattern, in case it goes up or down. All right, let's start this over real quick, and let's do the type 2 pattern now. So there's your Asian range accumulation. And then here's type 2. You have your range here, moving down. And then here's what happens. So here's your false move. And there. Okay, this is a type 2 pattern. All right, so the biggest difference with type 2 pattern that you'll notice is that instead of the stop hunt going past, instead of the stop hunt going past the Asian low, okay, and coming all the way down here like type 1 did, right? This type actually doesn't go past the Asian low. It still makes the W, right? But it does it at the Asian low. Okay, so it does it at the Asian low is the difference. So there's the Asian low, and there's your type 2 pattern. You have your first leg of the W, second leg of the W, rise. Okay, so this right here would be considered a type 2 pattern. All right, I'm going to go ahead and show you what that would look like the opposite way. So the opposite way of that type 2 pattern would be this. We're in the Asian range, come up, boom, boom, and drop. That would be your type 2 pattern going the opposite way. Okay, again, this is what makes it a type 2 pattern, is it creates the M at the Asian range high. So it's going to make it at the Asian range high or the Asian range low. Okay, so as long as it does that, that would be a type 2 pattern. Okay, so Asian range low or high. If it makes the M and at the higher low, that would be a type 2 pattern. All right, so let me go ahead now and show you type 3, the last type of pattern that you're going to be looking for. So again, we'll do the Asian range. There's the Asian range, and then again, here's price moving up and down. And And then what'll happen is you'll get something like this. This is going. So that is a type 3 pattern. Now, what makes this a different type of pattern is, as you can see, we are making a W formation in the middle of the Asian range. Okay? So we're making the W formation in the middle of the Asian range. That makes it a type 3 pattern. Okay? If we were doing it the opposite way, it would look something like this. So it looks something like that. And again, what makes it a type 3 is that it's doing the M in the middle of the Asian range. Middle of the Asian range. Okay, that would be a type 3 pattern. All right, so that would be the type 3 pattern. So type 1, let's do a quick recap here. Type 1 pattern has the stop hunt going below or above the Asian range to create the higher low, the new higher low of the day. Type 2 pattern does the higher and low at the bottom or the top of the Asian range, so here or here. Type 3 does it in the middle. So type 3 does the M or W in the middle of the Asian range. Okay, so those are the 3 different types of patterns. Now what I'm going to do is I'm going to show you those patterns on an actual chart so you can see what they look like when you have candles on them. All right, so let's go ahead and take a look at those now. All right, guys, so let's go ahead and take a look at the 3 different types of patterns on the charts. All right, so let's take a look at some type 1 setups here. All right, so on this type 1 setup, you can clearly see we have our Asian range, and then we have our trap move, right? We have our trap move past the Asian low, came back up, and as we talked about before, they did not come back all the way down to retest that because they got all the orders that they needed from traders that they wanted to be selling to go up. Okay, so this is something that you'll see is you see how many times they try to go low, and that's just because they do this typically when they don't have the amount of orders that they want. So they want to entice as many traders as possible to go short on this, and they will do as much as possible. Most of the time, what you'll see is they will go 25 pips below, around up to 25 pips below the Asian low in this example. Okay, and if they don't have enough orders that they like from people that they want to sell, they'll go another 25 pips. So total 50 pips down possible that they can go down. And here's an example of it. Okay, came back down and boom, and we rise. All right, so that is one example of a type 1. Let's go to another one. Here's another one. So we have our Asian range, and then here we go, the more typical one. We have a false move to the bottom. We have our W here, and then we rise. See that? On the type 1s, we're passing the Asian low. We're going down, creating the first leg, come back for the second, and then we rise. This right here is just a written example of what I showed you before. This is what we're looking for on a type 1 setup. Here's another one, Asian range, and we have our false move to the Asian low, came back up, came back down, and boom, and we took off. Okay. And this example, by the way, was in the middle of it forming. As you can see, I was typing, this looks like a type 1 setup to go long, and once we have a nice W form. And this is something that I was sending to one of my students here. All right, let's take a look at another one. Here's another one. So we have our Asian range, false move to the bottom, came back up, and this time, look at this one. This time, we actually went past the low on the first leg. This is done to induce more traders to go short on this. And then as soon as they get enough orders, they pull it right back out and they rise. Okay? So this is important. This is why I wanted to show you real charts of how it looks like, because sometimes it doesn't look all pretty like a perfect W. This are the things that you're wanting to look for. Okay, let's look at a couple more. Here's another one, false move down, came back up, came back down, and rise. Here's another one, Asian range here. Here's our false move, came back up, retested, and then drop. Okay, and the last one. On this one, we have our false move down, and just like I showed you previously, we didn't create the W, we railroad tracked this one, and we rose. Okay, and I'm going to go over the different types of setups that you'll see besides the W when you see these patterns. Okay, but first I just want you to understand the patterns that you're looking for. All right, trust me, we're going to go over all that in another video. Okay, but this is another example right here. All right, let's take a look at type 2 setups here. So here's a type 2 setup. We see the Asian range, and look how we're sticking right to the low of the Asian. We hit it, hit it, hit it, and then finally rise. Okay, when you see something like this, they come back, they hit it the first time, come back up, hit it again, come back up, hit it again, come back up, hit it again. This is all done 4 hits to the low. This is all done to, again, induce traders to go short. This is what they do to make traders go short. If they don't have enough orders filled, they will keep hitting it and hitting it and hitting it until they get what they want, and then they'll rise. Go ahead and look at another one here. All right, here's another one here. Here is the W right here. We have our first leg, come back up, second leg. You notice how we're at the bottom of the Asian range, and we rise. Okay, stop hunt, come up, stop hunt, rise. Here's another one here. Came down, we did our first leg here, came back up, came down for the second, and we rise. So here's a W here, we rise. This is 44 pips here. Here's another one. Came down to the Asian low of the range. We hit it twice and rise. This one, as you can see, we went just a little bit below, but we didn't go far below it. So this is still a type 2. Okay, and as you can see, when we came back to hit it again, look what they did. They induce, remember this candle was all red. They're inducing traders to go short. And then as soon as they have enough orders, boom, they take it right back away. I believe this was the same one. And this is just a quick example of a type 2 setup that we showed you. Here's another example. Here's the first one here. Here's the first hit to the high. Came down, came back up. Here's another hit. And we made an M, right? But we even did one better. We had extra confirmation with railroad tracks. And boom, we dropped. Okay, so that's another type 2 pattern. Here's another one. We hit it 3 times. We hit it once, twice, 3. Again, inducing traders, inducing traders. Look at this candle here in the middle. Now, when this candle was forming, right, this was all the way down here. So this was red at one point. Remember that. This is red. This is how they induce traders here. And then they push it back up. That push all the way back up creates this nice little top here. And it induces traders. This is all they do all the time. But they hit it 3 times. And then they drop. Here's another one here. This is pound USD. And boom, look, they hit it 1, 2, 3. Drop. Here's another one. Came up, hit it, came down, hit it again, came up, hit it again, and then we finally rise. Okay? 3 pins. 1, 2, 3, 4, 5 times they hit it to induce traders. Alright? And the final one here. Here we go. Hit it, came back down, hit it. Don't have enough traders yet. Hit it one more time and then rise. Okay? So that were type 2 setups. And let's take a look at the last one here, type 3. Here's type 3 setups. Here's your Asian range. And then here we are in the middle of the Asian range. Boom, hit it again, and we rise, making the W, double bottom, boom. Here we're going the opposite way, in the middle of the Asian range. Hit it once, come back, hit it again, boom, down. This is an example again of a type 3 going down. Here's another example. Hit it twice in the middle of the Asian range and drop. Here we go, Asian range. Came down, hit it once, came back, and rise. And again, in the middle of the Asian range. And then the last one here is, here we have the first leg here, came up, came back down, and rise. And then also we did have this right here. These 3 bars together create what's called a cord of wood. And that's another part of a confirmation that we'll use, that we'll talk about later. Okay, that you'll see as well. But again, in the middle of the Asian range. Okay, so type 1 is well below or above Asian range. Type 2 is going to be at the low or at the high of the Asian, and type 3 is going to be in the middle of the Asian range. All right, so those are your type 3 setups, guys, for the patterns that we are looking for in the Forex market. All right, hope you enjoyed the video, and then on the next video we'll go ahead and get more in depth.